Today on this video, I'm going to talk about all things credit scores and how that relates to getting approved for a mortgage. As you know, credit scores are an important piece. Not all mortgage programs require a credit score, but we'll talk about that in a different video. On this one, let's talk about the fact that if you have a credit score, how do you improve that to improve your chances of getting approved for a mortgage? So first of all, your credit score is a 3-digit number that lenders use to assess your credit worthiness. And it's based on a few different factors like payment history, credit utilization, and length of credit history. So generally, the higher your credit score, the lower the interest rate you'll receive on your mortgage. On the other hand, if you have a lower credit score, you might be charged a higher interest rate, which could add up, of course, to thousands of dollars over the life of your loan. We want to try to avoid that, which is what we're talking about today. Okay, so in addition to your credit score, lenders are going to review your credit report itself. It's a tri-merge credit report that has 3 different scores, so TransUnion, Equifax, and Experian. Most lenders will use the mid score, not the average or the median, but the middle score. So whatever that is, that's the number that will be used to calculate or to qualify you based on the loan program minimum credit score requirements. So the credit report itself, though, contains a lot of detailed information, right, about your credit accounts, such as your payment history and outstanding balances. Another factor that lenders might consider, I shouldn't say might, they do consider, is your debt to income ratio, or DTI. So what this is, it's pretty simple. It's a percentage of your monthly income that goes towards paying the minimum required monthly payments on all your bills, including student loans, vehicle loans, and credit cards, and other bills that you might have. And it includes your mortgage payment, your new mortgage payment, including taxes and insurance. So it's a calculation of how much outgoing debt you have to pay every month compared to your gross monthly income. So to improve your chances of getting approved for a mortgage, it's always important to maintain good credit score and keep your debt to income ratio low and have a good, stable employment history. Here's a tip to improve your credit score, and that's to pay off any outstanding debts, particularly high interest credit card balances. Now, if you have credit cards and other revolving accounts, keep your balances lower than 25% of your high credit limit at all times, and that will also have a positive effect on your score. So it's important to, if you can't pay them off entirely, at least pay them down to 25% of your high credit limit and keep it at that level or lower at all times on all credit cards. It's also important to review your credit report regularly, of course, for any errors or inaccuracies. If you notice mistakes, you can dispute them with the credit bureaus and have them corrected. Might take a little time, but you can do it. There are some reputable, very few, but there are some reputable credit repair agencies out there as well that may be able to help you. If you're struggling with debt or have a low credit score, consider speaking with me about one of these credit counselors who can provide guidance on how to improve your credit and overall financial health. So wrapping it up here, your credit score and your credit report play a crucial role, as you know, in getting approved for a mortgage. But by maintaining a good credit score, keeping your debt to income ratio low, and having a stable employment history, you can really improve your chances of getting approved for the mortgage that's right for you. Please don't forget to like and subscribe to my YouTube channel and follow me on Instagram.